Hey everybody, welcome to Trading Capital. I have a very interesting analysis of the inflation rates going back all the way pretty much to the 80s, 90s, 2000, 2008. Basically all of the major crises that have occurred. And I want to display this chart, and I've put quite a bit of work into researching what has transpired during these certain periods and how we can use all of this data in this chart to give us the highest probability outcome to positioning ourselves correctly on the right side of economic policy. Essentially, economic policy is the true fundamental analysis that you should be incorporating when you're picking individual stocks. Some people may say that fundamental analysis of stocks is the most important. I disagree. Fundamental analysis of economic policy implemented by the Federal Reserve is going to trump any sort of fundamentals that a stock may have. When the economic conditions are not favorable, the highest probability of all stocks going lower is the most favorable outcome. So let's jump right into this chart. Essentially, we have two lines, and I'm going to break this down by event. We have the blue line here, which represents the federal fund rate throughout history. And as you can see, all the way back in 1981, we had the Fed fund rate at 19%. Imagine interest rates climbing to 19%. We would never be able to survive. And you can just see that this is what a clear bear market is described as, a series of lower lows and higher lows. And that's essentially what you have here with interest rates. This chart really distinguishes how sick our financial system truly is and the underlying issues that the future generations are going to have to deal with is pretty bleak when you look at this chart and truly know and understand what this means for the future. So, and the orange line here is the inflation rate over many years. So, going back to this first event here in the 1990s, the US, there was a war going on. I believe it was the Kuwait War, where US started invading, and here you had a multi-year inflation high, roughly at the 6.4% level. And you can see here that it's not the highest when you look at the history here, but you can see that you had basically a low. The lowest point was here. 1982 is when you matched up with that high, and then you pretty much went lower and lower and lower, and obviously that's due to technology. But when you hit a multi-year high, it was basically almost a 10-year high in inflation. That's when the economy started to really feel the pressure. You had inflationary shocks with oil due to the war. And what that caused was a major 1990s recession. So peak inflation caused, alongside with a couple other macro factors, caused the 1990s recession, which caused interest rates to collapse and bottom roughly at the 2.7% mark. So they went all the way from 9.83% at the high to 2.83. So the Federal Reserve is always behind the curve in the sense of where they lower rates, but it shows you when you have peak inflation, generally most scenarios something bad is on the horizon. Moving forward to the peak inflation in the dot-com bubble. Here you can see you had a series of basically one year of peak inflation, roughly at the same rate, and then what proceeded to follow was the dot-com crash. And then of course, with this blue line falling down, the Federal Reserve became a lot looser with their economic policy and lowered the federal fund rate to support the economy. So the Fed fund rate, again, from peak inflation went from 6.5 all the way down to basically 1%. Moving forward yet again to the next crisis, peak inflation, housing crisis. So here you had peak inflation in July of 2008, and then you had the housing crisis proceed, where Basically, it was one of the nastiest sell-offs we have ever seen in the real estate sector. The stock market was affected. It was not a very, very pleasant time. My family got personally affected by it, so that's why I'm so aware of economic policy and history, because I had skin in the game at that age, and it was not a pleasant scene. But often you learn the most from your hardest and darkest days. So again, you had peak inflation, housing market crashed, and the Fed fund rates were lowered substantially to the zero bound mark to support the economy. Moving forward, if you can notice here, look what inflation is at, almost 8%. Well, it is at 8%, and we get the newest number next month, which should come in a lot hotter, as it's going to reflect a lot of the commodity shocks from the Ukraine-Russia war. But what's very interesting and scary, if you don't do any historical analysis and don't have yourself positioned correctly on the right side of history, is here we have peak inflation. And notice, taking the last three crises, when you had peak inflation, a recession occurred, the dot-com bubble occurred, the housing crisis occurred. Well, here again, it looks like we're approaching peak inflation. Yet we don't know what the catalyst is going to be. The Fed fund rate is already at the zero bound mark, with the Fed currently tightening policy, potentially into a crisis. So we know peak inflation generally brings on some sort of crisis. We don't know what it's going to be. There's suspicions that it could be, I think, the bond market perhaps. It could be the real estate market for sure. It could be the stock market. It could be a combination, the trio of three crashes. But something on the horizon is brewing. And using history as a guide, when you hit that peak inflation, it's not long before that next crisis occurs. So just keeping in mind, what I also want to direct your attention to is this peak inflation here, roughly at 8%. Not only are we peaking, and it could yet again still keep going higher, it's higher than the 2008 crisis, it's higher than the dot-com bubble, and it's higher than the 1990s. The only area that it hasn't taken out is the 1980s, but we're more than halfway there. So that should be very, very concerning as a long-term investor, where basically we have higher inflation than the past three major crises. And if you recall, most people won't recall, but if you were living during these times, and I personally wasn't, but I'm a big study of history. That's why I'm putting together this chart, and that's why I constantly try to use history as a guide to see what governments did, what the sentiment of the people were. And when there's high inflation, it never turns out to be a good outcome. And this point of inflation is higher than the last three crises. And the scary thing is that we have this high inflation, and the federal fund rate is already at the zero bound mark, which leads me to think, when that crisis does occur, and it's not long after peak inflation, then will rates go negative? As you can see, the rates are constantly looking to put in a lower low on the charts. And we haven't put in a lower low since the year 2008, where they were kept at the zero bound mark, and then they rose a little bit, and then they were back at the zero bound mark with COVID. So with rates, and on a technical basis, charts always looking to make a lower low, it stands to suggest that real rates are already negative, but nominal rates should go negative. And that is something that US policymakers and US citizens have never experienced before, but it's truly something that you should be aware of and position for. But it does show you that you have to be aware there's a potential crisis looming. Now, do I think inflation has peaked? I don't think inflation has peaked yet. I think peak inflation will start occurring once the Federal Reserve implements quantitative tightening and they start reducing their balance sheet. Until they start reducing their balance sheet, I don't think interest rates alone will curb the inflation that we are currently dealing with, especially due to the supply chains, especially due to the Ukraine-Russia war, geopolitical tensions, and the massive amounts of money that have been printed over the last 2 years. Specifically in the US, 80% of the new currency in circulation has been printed within the last 2 years. That is an astounding figure when you realize how much money has currently been printed in such a short period of time. And when you print money in excess, history shows it never leads to a positive outcome. It's always the lower to middle class that get hurt. So being aware of these market cycles and these constant boom and bust scenarios is key to being on the right side of history. Once we hit peak inflation, on a historical basis, it should not be long until the economy falters. And I'm definitely in the camp that as the Fed tightens and they implement quantitative tightening and this next round of economic cycles, the economy will slow, the housing market will slow, the stock market will fall, and that will inherently cause people to try to save more by spending less. And right now we're seeing a substantial increase in inflation that we have not experienced in quite a long time. As you can see based off this chart, it's the point in time where we experienced this high of inflation was all the way back in 1982. That is going back a substantial amount of time, and it's just concerning because what can the Federal Reserve do? You know, inflation is not brought on by supply chains. Supply chains may increase inflation a small percentage point, you know, in regards to a specific product that is being constrained. However, inflation is caused by money printing. Excess money printing. When you have the President of the United States declaring that inflation is caused by Russia and Putin and the war, that is undoubtedly the most misleading and false statement that you could say to the American people. Inflation has been caused by our government, by our policymakers at the Federal Reserve, and that is that. You do not get inflation from supply chain constraints. Certainly not at the level that we are experiencing it at. So just keep in mind, once we hit peak inflation, which I think in due course we will, then, using history as a guide, some sort of crisis